What are ibonds? How do I even invest in them? And are ibonds a good investment? Well, for the better part of the past 30 years, the answer has been no. But that may be changing. ibonds, also called inflation-linked bonds, are issued by the United States government and are designed to protect the value of your cash from inflation. How do they work? Well, stick around and I'll explain the ins and the outs of ibonds and whether they may deserve a place in your portfolio. Hey there, Colin Exelby, Certified Financial Planner here, and I'm the owner of the virtual financial advisory practice, Celestial Wealth Management. I provide financial planning to business owners and their families that just makes sense. Look, you just can't escape the talk about inflation. Every night when I turn on the news, there is a story on inflation and how it is hurting the pocketbooks of everyday Americans. It's almost comical how often inflation is mentioned on the news now, but it's true and it's on people's minds. The annual rate of inflation in the United States hit 6.2% in October 2021. This is the highest rate in more than 30 years as measured by the Consumer Price Index. If you have money sitting in checking accounts, savings accounts, or even the so-called high-yield savings accounts, your money is probably earning you close to 0%. And that's a steep price to pay for having access to cash and the FDIC insurance that goes along with traditional bank accounts. If the cost of things you buy is increasing at 6 to 10% and your idle cash is earning 0%, you are guaranteed to lose 6 to 10%. Let me say that a different way. Inflation is the most devastating tax because you don't realize it's happening. You may have the same amount of money in your checking and savings accounts, but it's buying 6 to 10% less. What if I told you that there is a little known US government-backed bond that would pay you 7.12% annualized on your money? But to maximize the strategy, you must take advantage of it by December 31st. Well, it's true, and it's called an ibond. Investors are becoming more and more interested in stock and bond market alternatives that may be higher returning, lower risk investments, and this bond has the potential to do just that. Today's 7.12% annualized yield, it's far higher than any other government guaranteed interest rate that I've seen. So what is an ibond? Ibonds come from the same family of bonds as the much more popular but much lower yielding Series EE bonds. Ibonds are a unique, low-risk investment issued by the US Treasury to protect your money from losing value due to inflation. Because ibonds are issued by the US government, they have nearly zero risk of default, making them a very safe investment. So how is the interest calculated? Ibond interest is calculated by combining a fixed interest rate and an inflation-adjusted rate, and I'm going to discuss more on how that works in a moment. Ibonds earn the interest monthly, but you don't get access to the interest payments until you cash out the bond. The interest payment is automatically added to the bond's value twice a year. This means that the principal can compound semi-annually as the interest earned then pays interest. I mean, that's a feature that most bonds don't have. How are ibonds taxed? Well, the owner of the ibond has the option to pay the federal tax on the interest annually or when the bond is cashed in. Essentially, if you wait until it's cashed in, they could act like a non-deductible IRA contribution when you don't pay any tax on the IRA assets until they are withdrawn. Additionally, Series I bonds are exempt from state and local taxes on the interest. This makes them even more attractive in high-tax states like California and New York because your tax equivalent yield could approach 8%. When do ibonds mature? Ibonds have a stated maturity of 30 years, but don't worry, you don't have to hold them that long. That's just the point that they stop paying additional interest. An ibond must be held for a minimum of 12 months after the purchase, but after that can be redeemed at any time. There is a catch though. If you redeem an ibond between years 2 and 5, the prior 3 months of interest are forfeited. But at today's low interest rates, that penalty would most likely still yield you more than sitting in a checking or savings account earning pennies. So how do you calculate the interest rate? ibond interest consists of 2 parts: a fixed rate that's set at purchase and an inflation rate that changes every 6 months, typically November 1st and May 1st. Now you may not have heard of these ibonds because for decades they paid next to nothing. But in 2021, as inflation has ramped up, so have the payments. The November interest payment credited is an annualized rate of 7.12%. It represents a fixed interest payment of 0% and a semi-annual interest rate of 3.56%. That means for the 6 months after purchase, you would earn a return of 3.56%. Then, the interest rate is reset at whatever the government stated inflation rate is at that time. Let's just say the inflation rate is the same at that time as it is when you got it. You would earn another 3.56% for the next 6 months, making an annual return of slightly more than 7.12% because of that compounding effect we talked about earlier. Let's go take a look at this on the government's website at Treasury Direct to learn more. All right, so here we are on the website, and we're going to go over here in this individuals area to how to buy Series I bonds. And when we click on how to buy Series I bonds, what you can see is that right at the top, the initial interest rate on new Series I savings bonds is 7.12%. You can buy I bonds at this rate through April 2022. Okay, this part goes through all the stuff, what it is. Lots of what we're going through in this video is in more detail here. You can also look at how to register it, how to redeem it, replace it, convert it, tax considerations, but what we're going to look at is the rates and the terms. Okay? So as we look at the rates and the terms and how to calculate them, this tells you how the bonds earn interest. We're talking about compounding semi-annually, how this payment is made. We're looking at how do they figure it. They figure it with a fixed rate and an inflation rate, okay? Combining the 2 rates together, currently 0% for the fixed rate, 3.56% for the semi-annual inflation rate. That's how you get to this composite rate of 7.12. This is when the bond rates change. What have rates been in the past? I think this is really interesting. So we talked about why many people just didn't know about these bonds. Well, if you go back and you look at interest rates, this is a fixed rate for these bonds. They've been paying 0 since May of 2020, and before that they were 0.5%. Then they were 0, 0.1, 0.1, 0.2, 0 back in 2010. You got to go back all the way into the early 2000s to get an interest rate on the fixed rate of 1 to 1.5, and go back to 1998 to be getting 3. And that's when interest rates were like 7% for money in a money market. Now let's look at the inflation rates. Now, historically, you go back to 98, 99, it was like 0.6, 0.8, 1.7, 1.9. You know, these were a little bit higher in 0001, then they dropped down again. Couple times they reached 2.5% in 2008. Once in 2011 it was 2.3, but most of the time these inflation rates were below 1%. Here in 2015 it was actually negative, but not very much. And then all of a sudden, here we go, 3.56% in 2021. This is the highest that it's been. And here the composite rates for the I bonds. You know, this will show you when you add those fixed rate with the inflation rate, what those different bonds are paying. And, you know, it's about 7% for most of these bonds that are in here. You have to go back to the early 2000s and 98, 99, where you're at 8, 9, and 10% on these bonds. And you had to wait 15, almost 20 years before you were getting this type of interest rate, you know, on these bonds. So, you know, that's why not many people know about this, because it's more of a recent phenomenon with this 3.56 that just showed up in November. All right, let's head on back over and learn more about ibonds. All right, so now that we know more about ibonds and the history of them, how do you purchase an ibond? Well, you can invest in an ibond electronically online at the Treasury Direct website. There is not a secondary market for these ibonds, so you can't resell them. You must redeem them directly through the US government. Now, what are the limits? Of course there's limits. Digital ibond purchases are limited to $10,000 per Social Security number per calendar year. You must have a Social Security number and either be a US citizen living here or abroad or a US resident. And as a parent, you can also invest in ibonds on behalf of a minor child. So for example, let's take a family like mine, a married couple with 2 children. We could invest up to $40,000 each calendar year into ibonds, $10,000 for each spouse and $10,000 for each child. If you have a trust, you can invest in ibonds through the trust. It's extremely difficult to invest through an IRA or a Roth IRA, yet people still try to do it. Technically, it appears that you could find a custodian willing to invest the money on your behalf if you self-direct the IRA. But the hoops you might have to jump through can be significant. And additionally, if you did that, you'd lose one of the main benefits of ibonds, the tax deferral, because retirement accounts already have that benefit. As I publish this video, there are a few weeks left in 2021, and for the first time in nearly 30 years, there is an opportunity worthwhile in ibonds. In order to maximize this strategy, what you could do is open and fund ibond accounts with $10,000 before December 31st. Then invest another $10,000 in early 2022, basically getting $20,000 per Social Security number into ibonds at the highest interest rates in the past 30 years. Now, it's important to remember that any money you invest into the ibonds must be held for 12 months before redemption. In summary, if you have money that's sitting in checking or savings accounts that's not earmarked for growth investing and will not be needed in the near future, I think it makes sense to take a hard look at investing in ibonds. I realize that every person's financial situation and their risk tolerance is different. This is not personal investment advice. Do your own due diligence and discuss ibonds with your financial and tax advisors. And of course, interest rates are subject to change. They're not constant. Inflation could come back down a year from now, and these bonds might not be paying much of anything. Or inflation could persist and go even higher, and they could continue paying interest above other comparable investments. The future, it's unknowable, but for the next 6 months, we know that these bonds will pay 7.12% annualized. Now, do you already own ibonds? If so, let me know about your experience down in the comments. And if I was able to shed some light on these investments, make sure you give this video a like. And don't forget to smash that subscribe button, hit that little bell so you're alerted whenever I release a new financial planning or investment video. Get clear, be clear.